Good morning. I'm Tim Nyland, and today I'm going to give you my roadmap for how inflation becomes stagflation in the current market environment. In this part three of the Stagflation Clues series of weekly strategy webinars. Before we get started, I wanted to extend a special thanks to the audience for coming with us on this journey that we started a little over a year ago. Today marks our 63rd weekly strategy webinar, and we are about to celebrate 700 subscribers to the channel. We really appreciate every single subscriber that we get, and I have enjoyed all the positive feedback that I received. So again, thank you to everyone for spending precious time out of your day with me each and every week. If you'd like to do the kind of analysis you're going to see in this video, then you need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. Let's go ahead and get started. So as I mentioned, today's webinar is part three of the Stagflation Clues series, and I've gone ahead and highlighted parts 1 and 2 on the screen so that you could easily identify them. Part 1 being the 10-year tips or giving stagflation clues. Are you listening? Part 2, buying a truck to show what could drive stagflation. The Wednesday that I recorded part 1 of the series was where I found this particular article in the Wall Street Journal, literally on the front page of the business and finance section. And again, this is what prompted me to basically go out and buy a truck to experiment with the way that Ford is selling new cars. And this was obviously driven by the chip shortage that has hurt production and has led to strategy changes over Ford. So we're going to just take a quick, brief walk through some of the headlines. And the whole intent here is to show you how timely all this is as we begin to forge our roadmap here forward. That Friday, 8/20/2021, Toyota slashed output as the chip crisis intensifies. Again, this is literally in the front section of the Wall Street Journal. We reviewed this already. Then that following Monday, SEMA.org, the website that I monitor for bookings and billings of semiconductors, published the year-over-year percent change in actual billings of semiconductors. So if you look at these growth rates as we're coming down through May, June, July, these growth rates are just astronomical year over year. And if the automobile manufacturers themselves are still experiencing supply chain bottlenecks related to semiconductors, and they're having to still cut production, again, this is all timely within the last couple of days, then we know we've got semiconductor bookings that are even exceeding the billings, which is the manufacturing and billings of upwards of 50 to 60%, May, June, and July. So this is just absolutely unprecedented demand that we must keep our eyes on. Then on Wednesday, 8/25, and again, this is the Wednesday that I recorded part 2 of the series, it was announced literally as I was recording last week that Taiwan Semiconductor was going to raise prices by up to 20%. This is huge, huge news. And we're obviously going to dive deeper into this here in just a few minutes. But what I want everyone to see here is right up front in the article, it says that the less advanced chips used by customers like automakers will cost about 20% more. So we're going to dive into Taiwan Semi a little bit. We're also going to dive into what this actually means for margins throughout the supply chain. By Friday at 8/27, this Taiwan Semiconductor price increase hit the front page of the Wall Street Journal, and it was big. Okay, so by the time we look at Thursday, 8/26, another article caught my attention, and this was that Ford is going to cut their F-150 truck production due to chip shortages. And I had always said to keep your eyes on the inventories, okay? It's going to be the inventories that are going to dictate every move. And sure enough, when we look at Ford's inventory, you'll see that it's growing now as of Q2 2021, which ended 6/30 of this past year. It's growing 30% year over year. So this is year over year percent change of our balance sheet in our summary standardized financials out of the Zacks Research System. So the question is, if you look at normalized automobile inventories, you'll see that they're sitting at much lower levels on a normalized basis prior to COVID. And then once this semiconductor crunch hit the supply chains, you can see this inventory build, right? So perhaps this is the real reason why Ford is cutting production. So the question is, if Ford is cutting production and we've got this massive inventory build, then where are all the vehicles? And lo and behold, on Monday of this week, another Wall Street Journal article catches my attention. Here are the Ford trucks piling up. And these Ford trucks are literally sitting in the parking lot of the Kentucky Motor Speedway. And they are piling up because these components are running short. Okay. Before we discuss Taiwan Semiconductor a bit more and move on with our stagflation roadmap, I wanted to take a moment to let you know about our next generation portfolio reporting capability that we just released for Zacks Advisor Tools. Portfolio reporting and advisor tools let you create great looking reports that visualize your strategies. With our latest enhancements, it's simple to share your work with clients and colleagues because it lets you generate PDFs you can print, attach, or export. The look of the PDF matches what you see on the screen, and you can even add a logo and other customizations. Learn how you can create exceptional portfolio reports from start to finish. To get our free guide, just follow the link in the description below. So who exactly is Taiwan Semiconductor? And more importantly, why should we care, right? So from our December 30th webinar on 4 stocks to corner the semiconductor market, by the way, I still have that slide deck. If anybody wants it, you can just go ahead and email me, and I will give you a link to that webinar here in just a minute. Stock number 4, if you remember that webinar, it's all roads lead to Taiwan Semiconductor. At the time I did the webinar, Q2 of 2020 was the actual date that Taiwan Semiconductor actually became the world's largest semiconductor, passing Intel, NVIDIA, and Samsung. Most advisors were not aware of this fact at the time. Interestingly enough, by Q3 of 2021, literally this is just within the last couple of days, Taiwan Semiconductor now accounts for more than half the global semiconductor manufacturing by revenues. And Taiwan Semiconductor produces more than 90% of the world's most advanced chips. Recall that from that webinar on December 30th that Taiwan Semiconductor is not a member of the S&P 500. So obviously there is an opportunity to add alpha here versus the S&P 500. It is tempting, but be careful. Remember that Taiwan Semiconductor has a lot of geopolitical risk right now with China. And it's also a current Zacks rank sell. And I'll show you the price earnings chart here with the Zacks rank sell in just a moment. But keep in mind that Taiwan Semi is literally 2 to 2.5 years ahead of Intel, still ahead of Intel on the 7 nanometer transistor fabrication cycle, and is already working on the 5 nanometer fab as we speak. The Milton scale of this company is absolutely massive. It manufactures chips across all industries for the likes of AMD, Apple, NVIDIA, again, GPUs, CPUs, even for the Apple new M1 chip that's used in the MacBook Pro, that's developed on Taiwan Semi's 5 nanometer fab cycle. Keep in mind that we've got the mega cap tech names that are all vertically integrating their cloud server processors. That includes Microsoft, Amazon, Google, Facebook, you name it. Specifically, Amazon utilizes Taiwan Semiconductor in their custom chips that they use on their cloud servers. Okay. So here's a picture of Taiwan Semiconductor and that Zacks rank of sell. You can see the Zacks rank sell up here. Interestingly enough, they have a Zacks rank sell. They've been trading flat, a lot of geopolitical risk here, and they're spending a ton of money, right? Just an absolute ton of cash. So cash flows being hampered here. $100 billion has been committed over the next 3 years on R&D and factories to support this chip capacity, this production crunch that we're in right now. So a lot going on at Taiwan Semi. This is the December 20th, or I should say the December 30th of 2020 webinar for stocks to corner the semiconductor market. All of that information is still relevant. Just be advised if you go back and look at it now, a lot of those Zacks ranks will have changed. So if you've got questions, want to see any of the research reports or updated Zacks ranks, if you're not currently a subscriber, just reach out to us. We'd be more than happy to get you that information. Okay. So why should we care about Taiwan Semiconductor's price increase, right? So it should be obvious by now after last week's webinar that semiconductors I consider to be the new crude oil, literally impacting every aspect of our lives in virtually everything we do. We can't even put on a smartwatch, a smartphone. Our appliances are all connected to the Wi-Fi. Our vehicles are connected to our Wi-Fi, even have hotspots in them. I mean, literally semiconductors are everywhere, right? So economically speaking, when you hear about price increases in the short term will push down demand to preserve supply for companies that absolutely need the chips. Well, the irony here is that everybody needs the chips, right? So we immediately have to shift to the long term, and the long term economic impact is that prices are either going to increase at the retail level, or those costs are going to be absorbed by corporations. And at this point, from the looks of what's going on with profit margins, it appears as though most companies are pretty successful at passing along these cost increases right down to the consumer. So the significance of Taiwan Semi's price increase is that this is actually a manufacturing level price increase, right? So this is just as impactful as, say, a raw materials price increase. And the reason why this is important is because of where this happens in the supply chain. You're going to have margin effects that'll actually make the Taiwan Semiconductor price increase even higher once it reaches consumers. So 0.5 down here, I've got a real basic supply chain where we have raw materials, go to the manufacturer, go to the wholesaler, go to the retail, go to the consumer. And each one of these steps, there is a target profit margin. And so any cost increase will get basically compounded into that level of margin and basically get marked up. By the time it gets to the consumer, it ends up being a lot more than a manufacturing level price increase. Okay. So point number 6 pretty much summarizes that. Manufacturing level price increases will compound by margin levels at each step in the supply chain. Okay. So when we start talking about cost push forces, we have to understand how this can actually lead to recessionary forces that could ultimately lead to stagflation, cost push being one part of this equation. And it happens in 2 ways, right? We have cost push inflation contagion. When you start getting this 10 to 20% increase in semiconductors happening at the manufacturing level, this is going to push literally through all aspects of our economy. Remember the reach that semiconductors have. And this is going to further contribute to cost push inflation currently underway. So prices are going to continue to rise. These increases that Taiwan Semi is going to pass down somewhere in the neighborhood between 10 and 20% aren't expected to hit until next year. So what ends up happening is it starts hitting margins. You guys know that I'm big on margins. I do a lot of margin analysis. You've seen me do margin analysis in the webinars. And there's a real delicate balance here between the consumer and prices literally at every level of supply chain. So let's go through basically the 3 phases here. And phase A, corporate revenues and margins will continue to rise so long as they can pass the costs along to consumers across the entire supply chain in the form of higher prices. Okay, this happens early on in the cycle. This is the reason why I say that margins are cyclical, right? Early on in the cycle, we get these cost increase. It's much easier to pass these cost increase on to the consumer. Point B, right? At some point, these consumers are going to push back on the price increases. At that point, demand will fall, corporate revenues and margins will decline, okay? When that happens, you'll start getting that consumer backlash flow throughout the pipeline, and that's what point C is. And supply chains and corporations are going to look for ways to absorb those costs to keep prices low. At this point, this is where you get that margin rollover risk. This is one thing that I always refer to when I'm looking at stocks and I'm looking at the sustainability and supportability of earnings growth and revenue growth. One thing I always want to know is where they're at in their margin cycle, right? So if corporate revenues and margins continue to decline, and this happens across these supply chains, this economy will then begin to slow, layoffs will ensue, and unemployment will rise. This obviously is a recessionary force, and in the right economic environment can obviously lead to stagflation. But what is the wild card that we're missing for stagflation? In order to answer this question, we need to think back to last week's webinar and think of Milton Friedman's monetary case, right? So recall from last week's webinar, Milton Friedman did not believe in cost push inflation, right? He believed that inflation is always and everywhere a monetary phenomenon. My comment last week was, well, Milton Friedman doesn't have to worry now because we have cost push inflation plus this monetary phenomenon going on. So we've got the best of all worlds. But we had a really, really good question come in from our one of our weekly strategy viewers that last week by the name of Wolfgang. And I've actually got his question up on the screen, and it's actually going to lead us into this monetary case, right? So he says, as in physics, every force has a counterforce. So we can expect that push-induced price increases may very well cause a pullback in demand by other segments of buyers who can't keep up. True statement, right? Question is how much the money supply offsets that. Should a pullback in demand, we've already seen in housing, somehow coincide with a Fed tightening, we may be looking at an implosion, right? True statement, right? This is a really, really good comment, and I really appreciate the participation. So what we're going to do is obviously we're going to look at the money. Those of you that have seen my webinars know that I love looking at M2. Most economists do. And what I want you to see in this chart is just this rapid expansion in M2. And this coincides exactly at the point of COVID, okay? So this is basically deficit spending on COVID stimulus. I'm going to prove it to you here in just a minute. But what I want you to see is that this M2 money supply is up a staggering, literally 33.6% since February 29th, 2020. So that's literally the expansion of the monetary base, the money supply. Okay. Next slide we're looking at out of the Zacks research system is an interactive chart on the federal deficit, specifically federal deficit spending. And if this continues at a large scale, right, this is going to continue to increase that M2 money supply. So you saw the M2 money supply skyrocketing. The federal deficit, here's our over $3 trillion that we spent last year on COVID stimulus. Okay, you can see that deficit. So this is also going to increase that public debt. Remember from a few webinars ago, I always talk about public debt relative to GDP and the fact that we're sitting at about 125% of GDP right now. So the result of this is going to be a drag on long-term economic demand, right, which is going to slow down economic growth because we need to monetize more debt to service our outstanding debt obligations. This is going to continue to push inflation higher for longer periods of time, okay? So federal deficit spending equals slow long-term economic growth plus long-term inflation risk, okay? Next slide is, I said up here, and as luck would have it, deficit spending is not forecast to end anytime soon. So I went ahead and pulled the Congressional Budget Office's latest budget and economic outlook as of July 2021. I actually have a copy of this, and I'm more than happy to send this to anybody. If you go ahead and email us, we'll get it out to you. But what I want everybody to see here is that we are going to sustain annual $1 trillion plus deficits through at least 2031. That's the current forecast coming from the CBO. Okay, this is huge. So the point that the piece of this that we're missing is we don't yet have the velocity of the M2 money supply. Okay, this is where the rubber hits the road. And we've talked about this. It's been several months, but we're going to circle back to it. The velocity of M2 is the real risk. Okay, so the very first catalyst to get that velocity of M2 to increase would be further deficit spending being allocated towards goods and services. So literally unleashing the capital into the economy and getting that money to turn over instead of being saved or used for debt repayment. Right? This stands for both future infrastructure spending programs as well as additional stimulus benefits. Recall that those stimulus benefits that were paid directly to the citizens of the United States, most of that was used to pay off debt as well as increase their savings, right? So we need that to be deployed in the actual economy and actually begin turning over for it to actually hit the velocity of the M2 money supply. Right now, we don't have any velocity at all. We've got the monetary base expanding and there's no money turning over. Okay, that's what this is telling us. The second catalyst is that banks need to lend at a higher rate. Again, this puts capital to work in the system. It's just not happening, right? This is just not happening yet. So what we have to do is we have to keep our eyes on the velocity of the M2 money supply relative to M2 itself, okay? And this is how we raise the risk of stagflation, right? So think of it like this. The larger the fiscal deficits become, the larger this M2 money supply in blue is going to grow, right? We already know that deficit spending is going to be with us at least until 2031, according to the CBO. It's going to be to the tune of at least $1 trillion each year to 2031. And as this grows, the greater risk of stagflation as the velocity of M2 increases. So, I mean, at some point, as we continue to expand this monetary base, we are going to get velocity of money. So, in other words, in this above chart, and this is, again, just an interactive chart out of the Zacks research system, M2 money stock on one axis, velocity of M2 money stock on the other. And it's the further the M2 money supply line diverges, okay, from the velocity of M2 money supply line, the greater the risk of stagflation once that velocity of M2 actually increases. So think of this blue line as just continuing to pile more wood on the fire. And so as each year goes by and we spend more and more, we're literally stacking more logs on the fire. And think of the velocity of money as the actual flame or the match, okay? Once the match is lit, this is going to start turning. The more money or fuel we have in the economy in terms of monetary base money supply, the more danger we are at experiencing stagflation. So let's put this all together, right? We've just painted a roadmap of cost push inflation plus monetary factors, okay? So let's review these cost push inflation factors. Taiwan Semiconductor's manufacturing level price increase is literally just one example of that cost push inflation working to embed inflation longer term. We already know from last week's webinar, right, that the supply chains and inventories still remain compromised. And we've got industry experts and corporations telling us that the forecast for normalization isn't going to happen until 2022 and 2023, and perhaps even beyond in some cases. And this doesn't even account for inventories, okay? So we've got a real cost push inflation concern here that's really trying to embed inflation longer term. So that's one factor, okay, contributing to this long-term threat of inflation. The other side of this equation is the Milton Friedman side, the monetary factors, right? Deficit spending is increasing the M2 money supply. The larger the M2 money supply goes, the more public debt increases, right? To service the increase in public debt, we have to monetize more debt, okay, in the absence of growth to pay for our own debt. The threat of long-term inflation increases as we monetize more debt. Okay, so this becomes a real vicious cycle. And as we monetize more debt, the drag on long-term economic growth increases. So at the end of the day, we end up with the following formula. When you combine cost push factors together with the monetary factors, we have this long-term threat of inflation plus the long-term drag on economic growth is going to give us this greater risk of stagflation, right? That's the roadmap. So how does this end, right? There's basically two ways out of this. And either way, the reputation of the Federal Reserve is again once on the line, just like it was back in the 1970s. The first option is the option we all hope and pray for, that inflation finally arrives and it's the result of strong demand, rising GDP growth, and a roaring economy capable of someday, and I have someday in italics here, servicing its own debt obligation, right? We already know that public debt as a percent of GDP is already running to the tune of 125%. So I have someday in italics, knowing that in order for us to get out of that, we've got to grow GDP and slow down that spending. So the Federal Reserve in this scenario is free to normalize rates to accommodate moderate levels of inflation, which is overall healthy for the economy and for the continuation of the current longest equity bull market in history. So if we can achieve scenario number one, this is what we all hope and pray for. Scenario number two is the one that is the most frightening. And the scenario is this, right? Inflation finally arrives and is accompanied by weak demand, a slow growing economy loaded down with debt, requiring further monetization of debt to service its debt obligations. And that in turn slows the economic growth even further. So we just continue to go through this vicious cycle. It's almost like the Federal Reserve and the U.S. government is literally fanning the flames of inflation just to continue to be able to service its debt obligations, right? It's a really nasty cycle. And this is challenging for the Federal Reserve, right? Because they need to raise rates to thwart the risk of high inflation, but at the same time, they face this increased risk of a recession. And this event in and of itself would mark the beginning of stagflation and the end of the longest bull market in history. So the conclusion here is that the Fed must remain accommodative in its policies to support a high demand, growing economy capable of someday servicing its own debt. Okay? And that's the roadmap. That's about it for this week. Thank you all for attending. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or if you're looking to upgrade your current subscription, please contact our world-class support at Advisor Tools at Zacks.com and ZRS at Zacks.com. You can also send me an email or any of us an email requesting any of the slide decks or any of the materials that you've seen in this webinar today. Thank you for watching, and I'll talk to you all next week.